For the first problem, we will be going to calculating NPV. So what we're going to do is make a table of 0 through 3 for the years, and then plug in the values as it gives you, except for the year 0, it will be negative because it's investment and you're putting money into it. And the other ones are going to be cash inflows, so they'll be positive. And what we're going to do is just type in the NPV formula, except since NPV only includes the present value of future cash, you're going to need to manually put in the year 0 at the end to accurately get your answer. For problem 2, we are going to use the same data from problem 1, and the difference is instead we just highlight all the cash flows into the IRR function to give us the answer as a percentage. For problem 3, we have a similar concept here with 2 different projects, and you get the information from each paragraph. And similar to the previous problem, where year 0 is an initial investment, so that will be negative, and then years 1 through 3 will be positive because they're cash inflows. And again, you just type in the NPV form or the function using the rate, and then just years 1 through 3 again, because that is the calculate of all future cash flows, and then adding year 0 by hand at the end to calculate both NPVs for project A and B. And for this, you'd want to accept the project with higher NPV because it's the estimate of the potential growth. So for this, you would accept project A because the NPV is higher. For number 4, we have a payback model where you set up the years 0 through 3, and looking at the paragraph at year 0, we have an investment or cost of $6,000, so it would be negative $6,000, and then for years 1 through 3, it would be $3,600 each time. And to find the cumulative amount for each, you'd first add year 1 to year 0, and then for that amount, you would take the cumulative of year 1 and add that to the beginning of year 2. And since that amount was already positive, you would want to take this project because it asked if you'd want to produce positive cash flow in 3 years, and you do it in 2 years. So you definitely want to take this without even going to the 3rd year. For number 5, we have another NPV problem where this you would set up a table years 0 through 8, and at year 0 you have an investment, so cash outflow of $1 million, so negative, and then years 1 through 8 you have $200,000 cash inflow, so positive for each. And this again, just using NPV, with the rate of 12%, you would again plug in the function NPV using the rate, and then since NPV only calculates the present value of future cash, you would use 1 through 8 and then manually type in year 0 to get your NPV. And since NPV is negative, you would probably want to reject the certain project. For number 6, we first calculate the IRR. So using the table for number 5, we will just use all the cash flows given and just highlight years 0 through 8 to get a very simple formula to get the percentage. And then it says what decision should be made if the required rate of return is 10%. So in this case, again, use NPV to use and it finds only the future cash. So you would do 1 through 8 and then add 0 manually, but with a rate of 10% this time. And NPV is then positive in this case. So you would want to accept the project. And this is because there's an inverse relationship between present value of positive cash flow and interest rate. So basically when the rate is decreasing percentage, like from 12% to 10%, the present value will go up. As you can see, we had an initial negative NPV and now it is a positive NPV. For number 7, the answer is NPV. For number 8, a erroneous result for an unconventional cash flows, which wouldn't be negative at first and positive after, would be IRR. For number 9, since NPV, IRR, and payback period all can be used as decision-making methods, the answer would be none of them. For number 10, we have a income statement. So since we were just trying to find the operating cash flow for the project, we won't be using the $28,000 in net working capital. And what you can do is just set up a table where you can plug in sales for $75,000, as you can see in the paragraph, and then cost, which also says $57,000, and then depreciation. To find that, you would divide the $87,000 in fixed assets over the 5-year life. So $87,000 divided by 5 would be $17,400. And then to find the taxable income, you would subtract sales by cost and depreciation. And then taxable income would then be multiplied by the percentage, the tax rate, which in this case is 30%, to get the net income. And then basically to find the operating cash flow, you take that net income and then you go take back the depreciation value from before and add those two together to get the final answer, which in this case is 17,820. For number 11, we were finding the net present value of this expansion project. So for this, since we are not giving the total cash flow, we have to find that. So it tells us that the operating cash flow is $26,000 for each year. So for years 1 through 4, we will each have $26,000. And then it also goes to say how there's a total, or there's a $39,000 of investment in the beginning. So that would be negative for year 0 for investing. And there's also a $3,000 of net working capital at the beginning, which again would be negative in year 0, which 100% will be recovered. So for year 4, it can be a positive net working capital of $3,000. To calculate the total cash flow for each, you can just take the sum of the operating cash flow, net working, and also the investing. So in the case of year 0, it's just going to be negative because you have the net working capital and also the investing. But for lots of them, since there's no value, you just carry down the 26,000, except for year 4, you'll add 3,000. And then again, to find NPV, since it only takes the future cash, you will manually be adding year 0. And again, using the NPV function to highlight years 1 through 4, using the rate of 16%, and then also manually adding year 0 to give your value of 32,000. For number 12, we have a very similar problem to number 11, except this is with 7 years, and it tells us that there is a operating cash flow of 73,000 for all 7 years. So for years 1 through 7, we would put in 73,000 for each. And it also says that there's $10,000 in additional net working capital at the beginning. So for year 0, you'll have a negative 10,000 because that's a cash outflow. But that is also recovered at the end. So an inflow of 10,000, so a positive 10,000 in year 7 under net working capital. And you'll also have an initial cost of a machine of $249,000. So you're obviously purchasing that, and that would be a negative. So under year 0, you'd have negative $249,000. With at the end of year 7, in this case, you'll be salvaging 48,000 from it. So that would be an inflow of 48,000 at the end. And then similar to the previous one, you would just sum operating cash flows, net working capital, and investing to find the total cash flow for years 0 through 7. So for year 0, you would have a big negative number, and for the rest, you would have relatively all the same except for year 7 because you have that investing and net working capital inflow. And then using the rate, you would just use a basic NPV function. And again, like all the other ones, since NPV only calculates the present cash flow of the future values, you will only use 1 through 7 and have to manually enter 0. And then using the rate of 15%, the NPV function returns 71,801. For number 13, we have a lot of irrelevant information dealing with sunk cost, because at the beginning of the purchase, we have a $280,000 6 years ago, so that's obviously sunk cost. Then also at that purchase, there's $15,000 and $20,000, which in this case, you don't need to use for the problem. So the relevant information in this case would be the market value of $340,000, which is an opportunity cost, so technically negative. And then reading down, there's the building cost of $1.47 million, which is also relevant information. And that, since that would be a cash outflow, that would also be negative. So adding those two up to get the amount of initial cash flow for this project would be negative $1.8 million. For number 14, we have a multi-step problem that begins with the income statement to find operating cash flows. And most of the values are given, but you need to calculate some. So for sales, you would calculate it using the amount of units by per unit price. And then the other one you need to cost is variable cost, which in this case you would also use the amount of units, except instead of using the sales price per unit, you'd use the expected variable cost per unit. And then it gives you the fixed costs along with depreciation. So to find the amount of taxable income, you would take sales and then subtract that by variable costs, fixed costs, and then depreciation. So once you have that taxable income, you use the tax rate to find the amount of tax that would be used on that. and then subtract the taxable income by taxes to find the net income. And to find the operating cash flows of that, you would take the net income that you just found from all those values and then add depreciation back to that, the value that was given before, to find the total amount of operating cash flows. Now for B, C, and D, the most important part of these are just having the formula for each one. And then most of the information is just plugging in the formula, which is given pretty much in your income statement you already have or in the paragraph. So for the first one, we were finding accounting break-even. So we'd use FC plus D divided by P minus VC. And P is the per unit price, and VC is the per unit variable price or cost. And so for this, you would take the value of fixed costs, add depreciation, and make sure you have parentheses in order so you can calculate correct, and then divide that by, again in parentheses, the price per unit minus variable cost. And then for C, we have cash break even, which again is just another formula where this one we only have fixed costs divided by just, again in parentheses, price minus VC. I think it was a simple formula that Excel can work with. And for the last one, we actually be using the operating cash that we just calculated in part A. And again, we will add fixed costs in parentheses to operating cash flows, and then divide that again all by P minus VC to give us the final values, which in this case, we have the operating cash flows of $337,975, and then our accounting break even would be $1,450 or $1,450, and then at the cash break even will be $1,189, and then for part D, for the financial break even, it will be $1,872. For number 15, we have a question that's asking for accounting break even point. So again, we'd use the formula Q equals FC plus D divided by P minus VC. But in this case, everything is given but fixed cost. So what you would do is use like algebra. So it tells you the accounting break even of 14,600. So you would start with that and then plug in the values to FC plus 58,000 divided by 10 minus 4. And you would multiply then 6, or this is what I did. I multiplied 6 by the accounting break even point to give a total of 87,600. And then what I did was subtracted that value by 58,000 to give me the total fixed cost of 29,600. For number 16, we have a similar problem where it asked us to find the accounting break-even for how many cups of coffee you must sell, and also the financial break-even. So again, this is just all knowing the formulas. So for the accounting break-even, we have the FC plus D divided by P minus VC. And everything is given but fixed costs. But for this, it would be a very simple calculation. All you have to do is multiply the fixed cost of 0.34 for every cup of coffee, and it sells 212,000. So you just do 0.34 times 212,000 to give you the fixed cost of 72,080. And it gives you depreciation, and it gives you price, and it also gives you variable cost. So all you have to do is plug into the formula to give you your answer. And going to part B, or just basically the financial break-even, the only difference is not having depreciation and instead having operating cash flows. And in this case, it tells you the operating cash flows is 94,244. So the most important part of this is just making sure you get the parentheses right and the formula for each, like accounting or for financial. So for the financial one, we would add fixed costs, which happen to be 72,080, to the operating cost of 94,244, and put those in parentheses. So it does that first, and then divide that also by the price, which is $1.49 per cup, minus the variable cost of 63 cents, and make sure those are in parentheses so Excel can run it and get you your answer of a accounting break-even of 150,000 and a financial break-even of 193,400. For number 17, we have a very similar problem, except for this, the only tricky part is the depreciation. It says that the project requires an initial investment of $1 million, and that is depreciated straight line to zero, so it'd be $1 million minus zero, which is just $1 million. and over the 10-year life. So you divide by 10, which would give you 100,000. And you already have fixed cost, price, and variable cost given. So again, it's just making sure you plug in the formula correctly and get the parentheses correct so Excel can run it correct, with a final answer of the accounting break-even point being 1,500.